Wow. Obviously, we have lots going on in the world today and over the last several weeks. We've been talking with lots and lots of people. Many are worried, concerned, and even scared about what lies ahead. There are businesses closing around town and around the country. People are being laid off, furloughed, fired, unemployed, whatever you call it. But individuals and businesses are being significantly impacted by what's going on. There's a restaurant around the corner that we frequent quite a bit, and they are struggling to keep the doors open, not just for now, but potentially forever. Stories like this are being told all over the country, and so many of us are affected. Unemployment rates across the country are at an all-time high. I almost feel bad saying this, but our business is thriving right now. In these uncertain times, when people are scared, when people are losing their jobs, when people are losing more money than they ever thought possible, our business thrives. I am in the risk management business. In times like these, people find out they were taking more risk than they realized, and that maybe their plan isn't doing what they thought it would do. We help our clients understand the appropriate amount of risk that is right for them. We help our clients with safe money solutions, as well as guaranteed income throughout retirement. We help our clients with tax efficient planning options, or sometimes we help them realize how tax inefficient their current plan is. We're good at what we do and have been doing it for a long time. In times like now, in times of crisis, people beat down our doors for help. I, like many others, have been personally impacted, but my business has not. We're thriving when so many are not. We've put ourselves in a position to be able to help, to give back, to pay it forward. This is the community I live in, I work in, and I raise my family in. I want to support local businesses, local restaurants, places that are near and dear to our hearts. So here's what we're going to do. We're going to begin this 30 to 40-minute presentation. We're going to touch on many topics, very high level. It must be a high level because every plan is different, every situation is unique. On the back end of this webinar, you'll have a chance to schedule a 15-minute phone consultation with me. During this consultation, I'll have a chance to learn a little more about you, what's important to you, and what a secure retirement looks like for you. At the same time, you'll have a chance to learn about me, to ask me questions, and to learn about what we do for our clients. We will determine together if we think we're a good fit for each other and if it makes sense to begin the virtual process. For those on the webinar today that do stay on throughout the webinar and who schedule a 15-minute phone consultation, we're going to give you a $25 gift card. It's our way of giving back. I'm going to ask you to take that $25 gift card and use it out in the community. You know which business or restaurant is near and dear to your heart and who needs your help. Together, let's pay it forward. Now, let's get into the presentation. That said, there's a very practical aspect to taxes. Many of the financial decisions you make will have tax implications. Whether or not you use professionals to look forward at these implications is another story. My goal here is for you to leave with a much better understanding of how taxes are different in retirement and avoid some of the very common tax pitfalls. We'll discuss new tax laws, how changes impact your decisions. And of course, I'll limit the topics today because not everyone's beliefs are the same. So we'll stay away from any political thoughts or commentary. Okay. So one more note before we get started. We're going to focus mainly on the married filing jointly stats because that's most common to our webinar attendees. But other filing statuses such as single or head of household, the principles are going to basically remain the same. Okay, so let's look at some tax brackets, and it's pretty straightforward, similar to the system before tax reform. As you go up in income, the rate you pay goes up as well. New tax brackets have lower rates at each step, which is why most people will pay less under the new tax system. This tax structure is specifically for ordinary income, including such items as wages, IRA withdrawals, pensions, interest, etc. Okay. Now, let's take a look at this tax map. And there might be an easier way to visualize tax brackets. We call it in this slide the tax map, because it illustrates the rate at which each additional dollar of ordinary income is taxed. In retirement, two of the most common sources of ordinary income, as you probably already know, are pension income and withdrawals from IRA accounts. Notice from the zero tax bracket to about 26,000, there's no tax. That's due to a much larger standard deduction plus additional 2,600 for both of these clients for being over 65 years old, which we'll discuss in a few slides. From 26,000 to 45,000, income falls into the 10% bracket, and only the income that falls in that range gets taxed at 10%. For income that falls between the 45,000 and 103,000 range, this is taxed at 12%. If these ranges look really odd to you, it's because we've included the new standard deduction for married couples, which we'll discuss later in our presentation. And there are two spots on this map that are really worth paying attention to because there's big jumps. And hopefully you see them. The jump from 0 to 10%, and again from 12 to 22%, and the jump from 24 to 23% are where the biggest opportunities for planning and thus tax savings for you lie. Okay, so let's talk about capital gains and dividends. So capital gains and qualified dividends get their own brackets because they're separate from ordinary income. They are lower primarily to meet a public policy goal of encouraging investments in the economy. And there's still a marginal tax concept for capital gains and dividends, but the brackets are really considerably different. Okay, so here's a question. At what rate are capital gains actually taxed? Okay. Capital gains also have a marginal structure. You'll notice the 15% capital gains bracket roughly aligns with the ordinary income brackets. So long-term capital gains and qualified dividends that would normally fall in a 10 or 12% income bracket actually come through at a 0% rate. The reason is that the old capital gains system was effectively discarded or left behind in the new tax bill. We only get up to the 15% capital gains rate for gains that fall in the 22% bracket in this new system. So you guessed it, although 15% is a basic rule of thumb, it does not hold true all the time. Okay, so again, here's another tax map. If you had only dividends and capital gains on your tax return, you would pay 0. Okay, until you had enough to fill the 12% ordinary income tax bracket, which is less than $200 for 2019. For taxpayers in the highest ordinary income bracket, capital gains rate is going to be 20%. And so this is a really important concept, so make sure you note this, because it shows how capital gain taxation is actually linked to ordinary income. Once the combination of capital gains and ordinary income pushes you above this threshold, your capital gains become taxable at 15%. This structure really didn't change in the new tax bill, but because of a new, much larger standard deduction, the range at which it impacts you definitely changes. Okay, so this brings us to changes in deductions, exemptions, and credits. These reduce your net federal tax bill, effectively making the first several thousands of dollars in your household tax-free. So, deductions. You can think of deductions as reductions to income for certain things that you spend money on. You can track these things such as mortgage interest, investment interest, tax fees for preparing your taxes, and you complete a Schedule A, or you can take the standard deduction, which was increased dramatically. In 2017, it was $13,000 a couple. Now it's $24,800 for a couple. It's estimated that only about 15% of the population will actually itemize. For many retired taxpayers, even before the increase, there were simply not enough deductions to warrant itemizing on Schedule A. So once you reach 65, or if you're blind, you get an additional deduction of $1,300 each if you're married, or $1,650 if you're single. This provision was retained in the current law, the current new law. Okay, so exemptions. What changed? The personal exemption is gone. For 2018, it would have been $4,150 per person in a household in 2018. In general, for a couple, the combination of personal exemptions plus standard deductions would have been slightly less than the new standard deduction. So, credits. So deductions and exemptions reduce your taxable income, indirectly reducing your tax. Credits, on the other hand, directly reduce your tax bill. Tax credits are specifically designed to incentivize behavior. Two of the most common tax credits are the healthcare tax credit and the earned income tax credit. A less common one, but one that may be accessed by some people who take a part-time job in retirement, is the Savers credit, which basically incentivizes lower income people to save into their retirement accounts. So remember, even if you've been a high earner all your life, your tax return may be set up to present you as a low earner between the point of formal retirement and the time you're forced to begin taking your RMDs, or your required minimum distributions, from your IRA accounts. Okay, so back to deductions, exemptions, and credits. So let's look at an example. This is an example of a couple with $38,000 of gross income that is all ordinary income. At least $2,000 of the income must be in the form of wages. Okay, so first, we reduce that income by the standard deduction for a married couple filing jointly, plus the additional deduction for being over age 65. Then we take off $2,000 for a contribution to a traditional IRA to come up with our taxable income of $8,600. Notice how the deductions reduce the taxable income. Then we multiply that times 10%, since all that income falls in the 10% bracket. So that gives you a total tax bill of $860. Remember, credits are different than deduction exemptions in that they directly reduce the tax bill. In this case, the Savers credit results in a $1,000 tax credit, taking the total federal tax bill for these clients down to zero. Why only zero? Because this credit is non-refundable. You don't get the difference. Okay. So, middle income brackets. So remember how our tax map showed no tax up to $27,400? That was the impact of the new standard deduction plus additional deductions for being over 65 or being blind. So let's look at the real tax system. So realistically, if that were all there was to our tax system, it would be relatively intuitive. But unfortunately, in retirement, we see several complicating factors. And each of the factors you see on the screen creates an environment where you expect to pay, or what you expect to pay may not be what you end up actually paying. So we'll dig into each of these in this section. Okay, so let's talk about RMDs. The first complicating factor is required minimum distribution, or commonly known as RMDs. And most of our clients have saved pretty significantly into a 401k or IRA plan over the years. And generally, these contributions were pre-taxed on the front end. They came out of your paycheck or your payroll. So all withdrawals come out as ordinary income. Now, once you reach age 70 and a half, you're forced to begin taking withdrawals. And in the most recent act, it's actually changed to 72. So the process for calculating these withdrawals is relatively straightforward. Each year, you take the ending balance for the prior year, and you divide it by a factor representing your remaining life expectancy. So here's an example of this calculation. Okay, so how do they work? How do RMDs work? In theory, it's pretty straightforward and very similar to the system before tax reform. As you go up in income, the rate you pay also goes up. The new brackets have lower rates at each step, which is why most people will pay less under the new tax system. This tax structure is specifically for ordinary income. So this includes, as we said before, wages, IRA withdrawals, pensions, interest, that sort of thing. All right, let's talk about capital gains. When you think about capital gains, if you're like many people, you think, okay, 15% tax. And it's only when I sell something that's appreciated. Not really something that you should be that concerned about. What many people don't realize is that you can recognize capital gains even without selling anything, particularly if you own mutual funds. This is known as a phantom gain. And the best way to illustrate this is with an example. So let's say mutual fund A bought Apple stock in 1985. You bought the mutual fund in 2014 and held it till 2015. In the middle of 2015, the fund manager decides that Apple isn't such a good investment value anymore and sells the entire position. Any gain that was recognized on the sale must be passed through to the mutual fund to current shareholders, even if they didn't participate in any of the underlying gain of that stock. So the important thing to remember about capital gains is that if you've invested non-qualified money, it means not in an IRA, even if you are generally a buy and hold type of investor, it is likely you'll recognize at least some capital gains in some years. More importantly, when you experience a capital gain on your tax return, it can have a greater impact than just the tax on your gain, because it increases your adjusted gross income and may cause other deductions or exclusions that you were expecting to be phased out. All right, so Social Security is taxed based on your other income, which is important. So the best examples of the counterintuitive nature of how RMDs, or required minimum distributions, interact with capital gains to create ordinary income is through the taxation of Social Security, which can get a little complicated. If all you had on your tax return was Social Security, you pay no federal income tax at all. But when you have other types of income, it can cause your Social Security to suddenly become taxable. So it's common among advisors to say, hey, 85% of your Social Security benefits are going to be taxable. For high income people, 85% is often taxable, which means only 15% is tax-free. For middle and upper income folks, that's not necessarily true because it's based on a formula called the provisional income formula, which can have strange impacts. So let's take a walk through how this happens exactly. Your provisional income includes half of your Social Security benefits, plus all other taxable income, including dividends and realized capital gains, interest, and some non-taxable interest earnings, such as municipal bonds, which, as most of you know, is non-taxable for federal taxes. Okay, so let's look at some tax thresholds. So once we've calculated the provisional income, it's time to apply the thresholds. The key here is that only the provisional income that falls over the threshold creates taxable Social Security. And the best way to demonstrate this is how this works is by example. So let's take a look. So we'll do two examples, okay, both of which have a household income of $60,000. And in the first one, we have $20,000 of Social Security income and $40,000 of IRA withdrawals. So we take half of the Social Security, add it to the IRA withdrawals, and we come up with $50,000 of provisional income. Then we apply the first threshold. For a married couple, that's $32,000. We're $18,000 over the threshold, and 50 cents of each benefit dollar of that threshold becomes taxable. So we have $9,000 of taxable Social Security right there. All right, now we apply the second threshold, which is $44,000. We're $6,000 over the threshold, and 85 cents of over dollar becomes taxable here. So this creates an additional $2,100 of taxable income. We've already picked up the first 50 cents of each dollar in our first step, which is why we only multiply by 35 cents here. In other words, even though we have $60,000 of household income, only 55% of the Social Security benefit is taxable. Okay, so as if that wasn't complicated enough, let's take another example. Here we have $60,000 of household income, but in this one we have $40,000 of Social Security and only $20,000 in IRA withdrawals. We take half the Social Security, add it to the IRA withdrawal to get provisional income of $40,000. We are $8,000 over the first threshold, which creates $4,000 of taxable income, but we're still under the second threshold. So of the 40,000 of Social Security income, 36,000 is tax-free, and only 10% of the Social Security benefit is taxable. Okay, on your return. So when we bring these numbers onto your tax return, we see it a bit more clearly. The 401k IRA, the 40k IRA, and the 20k Social Security blend results in $2,500 of federal income tax. The opposite blend creates no federal income tax at all. So very interesting example of how one couple paid tax, the other paid nothing. All right, Medicare. So now that we've covered the most common way things that create confusion opportunity around tax retirement, these last few things we're going to discuss have a higher income, or for higher income people primarily, but could impact you in a year that, maybe you do a Roth conversion from your rollover IRA to a Roth, or you have a large unusual purchase. Medicare is now means tested, and these thresholds include your full Social Security benefit. If you fall over the threshold, you end up paying extra Medicare Part D and Part D premium. So you've got to be aware of this. In the scope of your total tax bill, it's probably not much, but it's not insignificant. These premiums are based on your income from 2 years ago. So it's worth paying attention to the thresholds as you consider how much do you take from various accounts. Okay, the net investment income tax. So a 3.8% net investment income tax also impacts higher income taxpayers. It creates an additional 3.8% tax on net investment income, which includes capital gains and dividends, interest, and even annuity payments. It also includes passive business income and rental income. Basically, if it's not derived from work or return of your own capital, and it falls over the 200,000 or 250,000 of adjusted gross income (AGI) threshold, it is likely subject to an additional 3.8% tax. All right, AMT, everybody's favorite. So the final distortion again applies only for people with higher incomes and a lot of deductions. It's called the alternative minimum tax, and it's a flat tax system. It actually runs parallel to our normal tax system. And prior to tax reform, it was estimated that fewer than 4 million taxpayers nationally would be subject to an AMT. Tax reform significantly increased the thresholds and phase-outs related to the AMT, so it will apply to only a couple 100,000 taxpayers going forward. If you are likely to be subject to it, and odds are, then you definitely need to consult your CPA for tax advice. Okay, so effective marginal tax rates. The complications we've just outlined should highlight one major point in particular. Over time, when government has needed new tax revenues, when doesn't the government need new tax revenues? This method has not been subject to change rates or brackets evenly across all taxpayers. Instead, it has been to introduce phase-outs of deductions or exemptions, or begin to include income that was previously not taxable like Social Security benefits. The result is a tax system in which the most important number isn't necessarily the tax bracket you land in, but your effective marginal rate. In other words, how much of your very last dollar did you actually lose to federal income tax? Okay, so back to the tax map. Remember, as you increase ordinary income from left to right across the bottom, you can see the rate that should be intuitively applied to your next dollar. Okay, so let's do a quick case study to illustrate the idea of effective marginal rates. We have John and Jane. They're married, filing jointly, both over 65, with 60,000 of Social Security income, 15,000 of long-term capital gain this year, and a $40,000 IRA withdrawal. All right, so the real tax system, ordinary income, here's their tax map. Okay, as you can see, They harvest a little over 10,000 in ordinary income, and then they begin to experience an 18.5% effective marginal tax rate. That's the point that their ordinary income plus capital gain drags enough Social Security into the calculation to begin making every additional dollar withdrawn from the IRA taxable at 10%. And each additional dollar over that drags another 85 cents of Social Security into the mix, creating an effective marginal rate of 18.5%. So you can see this couple never really experiences the 10 or the 12% brackets. They go from 18.5 to 22.2 to almost 50% before dropping back into their regular brackets. So very interesting. That's why this tax map helps so much. Okay, so if you're saying, whoa, wait a minute, 50%, and that spike occurred at the 12% bracket, how did that happen? You're not alone. Intuitively, this is a couple in the 12% bracket for ordinary income. You would expect $1,000 in additional withdrawal to create 12% of tax, or $120. But here's what actually happened. The $1,000 withdrawal did get taxed at 12% for $120, but then it caused $850 of Social Security benefits to become taxable, adding $102 to the tax bill, which then together caused $1,850 of capital gains that would have come through at the 0% rate to become taxable, resulting in another $277 in federal tax. In short, on that $1,000, the couple lost 50% to federal income tax. All right, and here's the tax map for capital gains. So, tools for tax control. The fact is that there's lots of ways to control taxes and plan in advance to create tax-efficient retirements. Diversifying among different types of accounts is very important that have different tax treatment, using tax-deferred products where appropriate, and blending withdrawals from different account types, not using something that's the same. And rather than simply harvesting in sequential order and paying close attention to which types of investments you hold in which account can make all the difference in the tax efficiency of your retirement income.
You were live.
In closing, we've discussed Social Security and why we must get it right. Tax efficiency throughout your retirement years, and getting a stress test of your current portfolio, ensuring that you have a retirement income plan that meets your needs and objectives. I believe there are two different types of people on the webinar today. Some on the call are worried and concerned. You don't have a retirement plan in place and you don't know if your money will last. You need help and you need it now. Others on the call have a plan in place. You're looking for information and education, and ultimately maybe peace of mind that your plan is doing what you expect it to do. You're simply seeking a second opinion. In either case, I applaud you for taking action and for attending this webinar. So, what's the next step? The next step is to schedule a 15-minute phone consultation to see if we are a good fit for each other. If we are, and we decide it makes sense to move forward, we will begin the virtual meeting process. The reality is that no is always an acceptable answer, and if either of us at any time don't think it makes sense to move forward, we won't. We'll still send over the $25 gift card, still do our small part in helping the communities that we know and love to recover and get back on their feet. Within an hour of this call, you'll receive an email to book your 15-minute consultation on my calendar. Thank you so much for your time today, and I look forward to speaking with you soon.